with Supermicro Computer Inc. trading in a live window around $37.61, following a blistering multi-day short squeeze and an explosive 33% surge over a 5-session winning streak. Retail investors on X, Reddit, and Webull are once again scrambling to decode the noise. The prevailing mainstream narrative loves to paint SCMI as a volatile, headline-driven momentum play, a high-beta casino chip tethered to the daily whims of artificial intelligence sentiment. But this superficial framing completely misses the structural reality of modern hardware engineering and data center deployment physics. While financial media anchors obsess over short-term price fluctuations and historical governance headlines, they completely overlook the fundamental bottleneck throttling the entire AI revolution: power density, thermal dissipation, and liquid cooling infrastructure limits. Modern hyperscale data centers are no longer constrained by software algorithms or raw chip design. They are suffocating under the sheer thermodynamic weight of NVIDIA's latest Blackwell and Rubin architectures. A standard rack housing legacy server configurations consumed 10 to 15 kilowatts, a load easily managed by traditional raised-floor air conditioning. Today, high-density AI clusters rack up anywhere from 100 to over 300 kilowatts per cabinet. At this scale, air cooling is rendered completely obsolete. Traditional server assemblers cannot simply bolt together off-the-shelf components anymore. They are fighting a brutal war against physics, where a single microsecond of thermal throttling can degrade multi-million-dollar model training runs. This is precisely where Supermicro's architectural advantage diverges sharply from traditional original equipment manufacturers. Through its proprietary data center building block solutions and advanced direct-to-chip liquid cooling technologies, Supermicro has positioned itself not as a commodity box builder, but as the indispensable gatekeeper of physical AI deployment. While retail traders chase green candles and panic sell on every minor macro jitter, institutional accumulators recognize that building out the infrastructure for the generative AI supercycle requires an unprecedented volume of custom-engineered thermal solutions. The market spent months pricing in margin compression and supply chain friction, completely blind to the reality that when hyperscalers need tens of thousands of liquid-cooled server racks delivered yesterday, they turn to the only company capable of modular, massive-scale customization: Supermicro. Market dynamics and institutional positioning. The recent price action of SCMI tells a masterclass story of institutional accumulation disguised by retail shakeouts. Over the past several trading sessions, daily trading volumes exploded past 160 million shares, accompanied by violent intraday swings that routinely trap emotional day traders using high leverage on retail-heavy brokerages. During periods of heavy macro uncertainty, fueled by shifting Federal Reserve rate expectations and fluctuating semiconductor sentiment, weak hands panic at the first sign of headline volatility, dumping shares into the waiting algorithms of smart money institutional heavyweights. This dynamic is clearly reflected in the options and derivatives markets, where implied volatility remains elevated, creating fertile ground for institutional option selling and stealth accumulation. While retail forums echo with exhaustion over past compliance inquiries and temporary margin pressures, institutional desks are systematically absorbing float, looking past the short-term noise to focus on the forward-looking cash flow machine. The massive post-earnings rally, which saw the stock jump nearly 20% in a single session on monumental volume, caught bearish retail speculators entirely off guard, triggering a classic short squeeze that forced hedge funds and short sellers to buy back shares at an accelerating pace. Market insight. Institutional sponsorship doesn't care about daily retail sentiment swings. It tracks order book depth, backlog conversion rates, and multi-quarter revenue visibility. When a company posts tens of billions in fresh orders, institutional capital shifts from defense to aggressive accumulation. Before we dissect the underlying operational mechanics driving these numbers, let's check the pulse of the market. Where do you stand right now on SCMI? Are you aggressively accumulating shares during these explosive momentum waves, or are you sitting on the sidelines waiting for a deeper structural pullback to enter? Drop your thoughts in the comments below. business model and historical context. To understand why Supermicro commands such a vital position in the modern hardware stack, we must completely strip away outdated historical framing. For decades, Wall Street pigeonholed Supermicro as a low-margin, commoditized server white box assembler, a cyclical hardware vendor competing in a race to the bottom against legacy giants like Dell and Hewlett-Packard. In that old paradigm, server manufacturing was a low-multiple game defined by high inventory risks, thin single-digit operating margins, and heavy exposure to sluggish corporate IT upgrade cycles. That legacy narrative is dead. Today, Supermicro is an advanced engineering-driven total IT solution provider, operating at the bleeding edge of enterprise AI, cloud, and edge infrastructure. The company's core operational moat lies in its proprietary building block architecture. Instead of designing monolithic, custom servers from scratch for every single client, which introduces massive delays and engineering costs, Supermicro maintains a vast modular library of server subassemblies, power supplies, motherboards, networking cards, and chassis. When a Tier 1 hyperscaler or sovereign AI cloud provider requires thousands of specialized GPU nodes, Supermicro can mix and match these modular building blocks to deliver fully integrated custom rack-scale solutions in a fraction of the time required by competitors. This modularity yields massive economies of scale and structural speed-to-market advantages. Furthermore, the company's aggressive push into proprietary liquid cooling solutions has fundamentally transformed its financial profile. As demonstrated in its blockbuster fiscal fourth quarter and full year 2026 financial print, Supermicro delivered a stunning margin recovery, with GAAP gross margins surging to 17.5%, up dramatically from the single digits seen in previous quarters. This margin expansion shatters the old bear thesis of permanent commoditization, proving that as Supermicro shifts its product mix towards high-value enterprise AI solutions and comprehensive data center liquid cooling integration, its profitability scales exponentially alongside its top-line revenue. Future outlook, catalysts, and risks. Looking out across the multi-year horizon, Supermicro's growth trajectory is anchored by staggering numbers that dwarf traditional Wall Street consensus. In its fiscal 2026 financial results, the company reported a massive annual net sales figure of $39.1 billion and guided fiscal 2027 revenue to an astonishing range of $65 to $72 billion, obliterating legacy analyst models that had penciled in far more modest figures. Driving this hypergrowth is an unprecedented multi-billion-dollar order backlog and over $60 billion in fresh orders, fueled by relentless capital expenditure cycles among mega-cap tech giants and emerging sovereign AI infrastructure builders. As artificial intelligence models scale from training trillions of parameters to real-time agentic reasoning and complex inference, the demand for high-density GPU clusters will only accelerate. Supermicro sits squarely as a technological gatekeeper in this ecosystem. Because the company maintains deep collaborative engineering relationships with semiconductor titans like NVIDIA, AMD, and Intel, it often receives early allocations of next-generation silicon, allowing it to design and deploy optimized server architectures before competitors can even secure engineering samples. However, navigating hypergrowth at this scale is not without structural risks. The company carries a substantial inventory balance, standing at nearly $13 billion to support its blistering revenue ramp, which requires immaculate supply chain execution and rapid inventory turnover to prevent working capital strains. Additionally, ongoing monitoring of global trade policies, export control compliance frameworks, and independent corporate governance reviews introduce pockets of regulatory headline risk that short-term traders love to exploit. Furthermore, while the recent 17.5% gross margin print proved critics wrong, sustaining these higher margin levels will depend heavily on the continuous adoption of advanced liquid cooling architectures versus standard air-cooled enterprise servers. Ultimately, investors who fixate on daily price volatility or short-term noise miss the forest for the trees. Supermicro is playing a foundational role in building the physical infrastructure of the intellect age, with an annualized revenue run rate hurtling towards $70 billion, a dominant position in liquid cooling, and an unshakable foothold in the enterprise AI ecosystem. Supermicro represents one of the most compelling, misunderstood execution stories in modern market history. Look past the noise, focus on the structural cash flows, and recognize that the hardware backbone of the AI revolution is being assembled rack by rack, day by day. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any financial decisions. Invest responsibly.